Non-stop, folks. Give me a second. I want to make sure we're streaming live. I was just telling Max I am starting to hire people, which is a big plus because God knows I need some time back. So hopefully I'll be able to do that and provide more of these types of live video streams with thoughtful people like Max here. If you're watching this, doesn't matter if you're watching this on X, on YouTube, on LinkedIn, on Facebook. I can see your comments. I can see your questions. So if you want to engage during this roughly 45-minute conversation, please post whatever your question is at whatever platform you're watching on. We'll make this as interactive as possible. As always, this will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. I had Max on a space, I want to say a year and a half, well, maybe a year ago.
It was January, yeah.
Probably, yeah. And it was, this is honestly God, true story. He was so good that he actually got a pretty big client out of it who happened to be a listener to that, which is a nice, which is kudos to him, right? Because obviously the way he communicates, as you'll see, is very thoughtful. We're going to be talking about markets, going to be talking about SPACs, and I don't think I've said the intro yet. It's been a long day. My name is Michael Guyad, publisher of the Lead Lag Report, and joining me for 45 minutes is Max Osbon. Max, introduce yourself to those who are watching and listening. Who are you? What's your background? What have you done throughout your career? And what are you doing now?
Sure. Thank you, Michael. So let's see. I run an RIA, Osbon Capital Management. It's been evolving for many years to get to a more sophisticated area. So we've done private market investments, early stage investments. And we run SMAs that kind of cover the range of retirement assets, which have particular risk requirements, and then SMAs that have high growth and high risk characteristics, which is kind of what I wanted to talk about today with Michael. And we also run a small hedge fund that has benefited pretty tremendously from Bitcoin. Started as a crypto focused fund, and we're probably going to continue to just broaden out the thesis there.
Is it fair to say that philosophically you prefer more disruptive type of investing, meaning Bitcoin is disruptive, right? I mean,
yeah. So my focus has really been on tech as a theme, just because it's something that I like, and that's some of the driving theme of what we'll talk about today. Why I like tech is a couple things which we've talked about over many years, which is tech has the added benefit of sometimes it goes through massive hype cycles. So you can, as long as you're early, being early helps tremendously. But when you get into a positive hype cycle, you can see some pretty tremendous gains. So being focused kind of through rough periods on tech and understanding where the strength is in the underlying asset, that can really set you up extremely well.
If you had to guess, since you're saying it's a hype cycle, what inning are we in? So I think a lot of people that are thinking through, hey, listen, there's been a tremendous strength in the NASDAQ, tremendous strength in tech, been the clear place to be for the last 2 years. Where are we?
Yeah, I don't think we're that far into it, honestly. If we look at there's some really interesting caveats that we have to say on this, because there are areas that are going through their hype cycle. So MicroStrategies, is such an interesting topic and kind of issue to discuss, but not my focus for today. Also, Palantir is one of the software companies with kind of an insane multiple back in sort of that 50 times sales range. That was kind of where we were around 2021 when we were close to the peak. But it's a little bit in a category of its own. So when I'm looking at kind of the peak or cycles or however you want to categorize it, you have to look at the details, or look at the details, what makes up that cycle, and with the majority of the top tech companies being in sort of low 20s or even teens sales multiples, it's not in the arena of absurd. With that Palantir being the kind of the only one that's kind of trading a bit like a meme stock, right? Defense tech, there's a lot of themes in there that are driving that stock.
I wonder if we've entered this phase where there's almost like an ADD aspect to the way momentum plays out, meaning you end up having, a bunch of people somehow latching onto a single tech stock, drives momentum, becomes the only place to be. And then other things which might be, substantially similar competitors are not really responding because they just haven't had the momentum to capture the attention and imagination. I frame it like that because it seems to me that if we are in that world where it's very sort of stock specific within a broader theme as opposed to everything benefiting rising tide lifting all boats, does that make your job easier or harder?
Oh, it's a great question, and that's actually again like the focus for today. I over time, the more you follow the details, the more shorts become a little more obvious, or longs become a little more obvious. Or in the semiconductor trade for the last 4 or 5 years, I think was a great rising tide theme where you didn't really have to do a lot of the underlying digging at the company level, because thematically you could look at it as how I've looked at it is it's the driver of like the global brain. So what it ended up with is NVIDIA being the tip of the AI spear, but at the same time, all of the global compute being kind of looped into semiconductors, or what is a semiconductor or what do they do? It's about compute and storage and just limitless collection, organization, processing of data, and doing that on global scale continuously. It's if you're into tech at all, it's just that that theme doesn't seem to be ending anytime soon. That's not a comment on the semiconductor industry or NVIDIA in general, but I think that was an easy theme. Now, looking at individual companies, I do, there are periods where I think long, short, or getting company specific work particularly well. I think we're in that kind of zone right now. However, I'll add one other caveat in this discussion. I can get specific on my views, but the breadth has increased quite a bit. So when we talked in January, it was really just that narrative of Mag 7 was the only part of the market that was going up. But now, you have small caps that have rallied, which, by the way, small caps have been kind of dead for many, many years, or we haven't really had peaking small caps in a very long time. They should, or historically have been, higher beta outperformers, and that's just hasn't been the case. The two factors that I've been watching for small caps is, you need falling rates and falling inflation. Both of those things have happened. And now you have Trump in office, Trump 2.0, which has unleashed a whole other layer of unknowns, but also positive unknowns. The areas that people I think are most excited about under Trump 2.0 are deregulation, which is just extremely broad. It's kind of like a tax cut, in that regulation costs money, but it also is it ungunks some of the system potentially, and it removes these kind of unlimited liabilities. If you're out of compliance on something or out of regulation, you could just have $250,000 or $1 million, tens of millions of dollars of liabilities, regulation law that you have to pay for. So removing that, and then potential for the peace dividend under Trump 2.0. If there is some case, I don't know the specifics or can't go into the specifics too much, but next year or the year after, if we can see a reduction in global conflict, that could open up quite a bit. So all of that kind of sets up larger breadth. ARK, which is like the Cathie Wood fund, which is so controversial among sophisticated investors, very popular among retail, is back above 60 today for the first time since the 2020, 2021 kind of world. I think that's really a big deal, round numbers and hitting new highs on those sort of controversial smaller cap innovative tech funds. That ARK above 60 is a really bullish market signal in my view.
Yeah, it's interesting, right? I mean, it seems like you're not going to have the same mania of 2020, 2021, right? But
right.
You are seeing some signs of life in some of these, what were then termed innovative companies, right? Disruptive, post-COVID, right? Everyone thought it would be the next big thing. Then they went round trip, but they're showing strength again. And I wonder if that strength is a function of the market's starting to actively believe that AI goes beyond NVIDIA?
I definitely, I've been mulling over this question with someone, which is, what would be an AI index, or if you were to create some kind of AI index, would you have to do it in private markets? Would you have to, try to get some allocation to all the major names that are private? And I think actually the S&P is just a fair proxy as an AI index, and I just say that because I'm a big user of all the AI tools, just as a fan of tech, and then I just like it. I use it for working out. I use it for cooking. I use it for research. But generally speaking, there is a academic term for productivity gains, which is like GDP per capita. But then there's also a very loose definition, which is just anyone at any level of any business can become more productive, or at least more knowledgeable, or at least stronger, if they're using AI. And I think they are doing it at all levels. So I think there's a massive continuous AI tailwind underneath. I also want to just say something about government supported markets, because there's always a bit of a cynical take, a justified cynical take, about government supported markets. I think it's pretty surprising how much the Fed balance sheet has shrunk in the last few years. I think people would be pretty surprised to see the Fed balance sheet has gone down by about 2 trillion. It is now back to 2020 levels. And at the same time, M2 money supply reduced for the first time, starting in 2022, was falling for the first time, has been back to growth. So M2 growing money supply is typically supportive of market liquidity. And, the Fed balance sheet has been shrinking, and that hasn't seemed to have had any impact whatsoever. We also have Doge going into next year, which should shrink government spending. It doesn't seem like that's going to have much of an impact. Could cause a recession, but again, we have no idea what they're going to do or how they're going to approach it. All of this kind of goes together into saying, like, it's not government spending that's supporting markets right now. It's a high breadth, bullish indication everywhere I can see. Momentum, of course. Momentum is always a huge factor.
You've been in the business for some time, and you and I both know that bullishness, overbought conditions, can stay overbought for a while, obviously. But there comes a point where the euphoria becomes, something you need to fade, right? What would be some of the signs for you that say, okay, we're getting a little bit too extreme here?
Yeah, I am not a big Ripple guy, but I did buy some and sell some, and now I don't own any. So compliance commentary. Don't take any of my trades. I can change any of my mind any moment. So if you want to talk to me about a trade, just reach out and we can discuss. But I keep my finger over the button. So there's no perma bullishness, perma bearishness in any of my comments. But when I saw I bought some Ripple and then I sold it. I saw what was going on with Ripple on Twitter. People were screenshotting. I sent a text to a friend who I was just in Vegas with playing craps. And I was like, this looks like the casino. People are just jumping up and down, clapping because the price is going higher. That's what it was like in 2021. I saw, euphoria with Ripple, so I sold, but I don't see much euphoria or screenshotting and posting your gains really anywhere else in the market. I think the majority of the participants in the market right now are riding out the S&P kind of like assets, which they have been since COVID and before COVID. So, really, realistically, a lot of people have those allocations, have had those allocations, and they have them globally. Everyone in the outside of the U.S. wants to own U.S. companies as well. So I don't think there's euphoria at new market highs with those assets. I think it's more, honestly, business as usual among the major companies, because earnings is there to support it. Typically euphoria would also mean that there is nothing underneath. Some of the quantum stocks have a bit of euphoria, but it's so small that I don't actually think it gets that much attention. I don't know if you would really even count those.
You mentioned earlier, it's like nobody really knows what's going to happen with Trump. And typically, volatility is a sign of doubt. Like I always say that the VIX index is not a fear gauge; it's really a doubt gauge about what comes next. Is there because you obviously still have a volatile bull market, right? Do you think that the likelihood of market path behavior is that it's going to be more volatile on the upside, or just kind of more steady eddy, kind of smooth the way we've seen?
Yeah, I assume volatility. So any of the risk assets that I'm buying or looking at now, expect a 20%, 30% drop or pull back at any given time. And I think that's the right way to approach this market, which is you have to expect that you're not going to be in a Goldilocks zone, which it feels like today. Market's in a Goldilocks zone, and that can change in any moment for any reason. So I expect more volatility, and I expect those drops. The reason I'm able to, I guess, buy with confidence is if you know what you own and you're comfortable with it, you can get through market volatility, and you can kind of also somewhat know where the bottom is. My favorite example has been Meta trading at, I think, 11 times earnings at the very bottom in its metaverse era. And then, of course, its AI era, has gone up about 550% from the low. But there was a point in time where you're looking at Meta and you're like, all right, Zuckerberg, incredible entrepreneur, incredible business, very numbers focused, growth engine, supported by earnings. Is this company really at 11? Should it stay at 11? Is it going to go below that? I think that was a fair margin of safety buying opportunity. So you want to know what you're buying. I don't see a lot of margin of safety in the major big tech companies, but if you know what you're buying and you expect volatility, then I think you'll do just fine.
I've always liked the margin of safety framework. And typically the margin of safety is pretty high after a cycle where a particular asset class has done really terribly.
Yeah.
And I think you can apply that to certainly the VC space and to SPACs.
Yeah, so that's what I was excited about talking today. If you talk to people who work in VC-backed companies or which there are many, I'm sure everyone has friends in that space. It's been in a depression. The companies who were expecting to get their exit in 2021 or maybe saw their exit within 12 months, in 2021, they've had to cut headcount. They've had to change their strategy, their financial strategy. They're not getting their term sheets for Tiger Global, from Tiger Global. The money's not pouring in. And honestly, they had to spend about 2 years where there was no growth. You couldn't get people on the phone to sell the product. You couldn't get any progress whatsoever. So as everyone knows, the world shut down on the VC side or, the early stage kind of tech side for about 2 years, 2022, most of 2023. Now it's back, moving. And so I like this concept of where can you get a private market asset class in public markets. And my favorite example is that a lot of the venture capital returns have more or less mimicked or been exceeded by what FANG was able to do the last 10 years in public markets. So you could have allocated to venture, or you could have just, kind of bought the earlier stage tech companies 10 years ago. You would have gotten roughly 10x your money on the public FANG assets. So where today are you seeing, representations of publicly traded venture capital or something that is similar to that? And I think it's in the SPAC world. Now there are a lot of SPACs. There were like 1,000 SPACs that came to market in 2021. Total disaster. For people listening, SPACs start at $10. They're publicly traded vehicle that raises their money before they go out and buy. And I think the most important thing that was the huge mess in 2021, an IPO of a particular company requires the company to only talk about what has happened up until that point, and then they can talk about their vision, but they can't publish future numbers. That's not true for a SPAC. What the SPACs are doing is saying, we're pre-revenue. We expect to get $2 billion in sales in 2 years. They can say that in the SPAC world. They can't in the IPO world. It just fueled the euphoria. it created a lot of nonsense. And now what you end up having is you have a huge collection of SPACs that are down over 90% from their $10, kind of SPAC IPO, or even worse because they kind of had some time to go vertical before they crashed. So when you're looking at sort of fishing for the SPACs, that you have to look for companies that have a share price of under $10 as sort of your first indication.
I feel like we should take a step back and explain what a SPAC is. I mean, a lot of people, a lot of people who are newer to investing, probably all they think about is just like, oh, these weird shell dynamics where there might be a company or not that went vertical and then they're dead. I mean,
yeah,
let's do basics here.
Yeah, so it's kind of an interesting structure because all you're doing is raising money as an acquisition vehicle. So you'd have a publicly traded ticker that has $300 million in cash. And there are a lot of dynamics with this, that really sophisticated SPAC traders will take advantage of. There's warrants, there's the ability to vote down the SPAC and just take the cash back. That's not really important in this case. It's really just a vehicle where it raises cash, and then they can take that cash and acquire another vehicle to take it public, acquire a portion. There was a lot of abuse. I'm not up to speed on all the abuse that happened financially, but there were some extremely expensive fees for some of these companies going to the sponsors when they were going public via SPAC. I don't think all of that was disclosed all that well, but yeah, a lot of the SPACs that happened, if you think SPAC, what you should really think about is a lot of companies that hyped their way into the market in 2021. Some justified, many unjustified, or many just far too futuristic. Like when I'm thinking about tech, it's cool that they have a cool vision and might be able to do something, but they're, time being wrong on timing is the same as being wrong. So it has to be something that's valuable within the next few years, maybe next 6-7 years maximum. Otherwise, there's no point in being public, and it's more of a public good, research project than a real business. So yeah, so the SPACs, they take a stake in a company, often a venture-backed company or something early stage or something, aggressive on the innovation side, and they become a public company through that SPAC.
And presumably, you may have alluded to this, they tend to overwhelmingly be on the tech side. Is that a fair statement?
Yeah, so I wanted to talk about 4 SPACs today. They don't have to be on the tech side, but they typically are. So again, not investment advice. I took positions in these 4 companies, but I could sell them tomorrow. I could sell them next month. I have changed my mind before, and I think the purpose of talking about these on the show is just I think this is an interesting way for people to look at markets, and I think they should think through these topics that we talked about in the last 20 minutes or so to arrive at this conclusion, and then consider how it might, they might want to participate or might want to research these particular companies or companies like these. Because I think there's a huge opportunity within the distressed SPAC space, and the 4 companies I want to talk about are by no means anywhere near comprehensive. But yeah, so again, not investment advice, but the four companies that I was looking at are start with Butterfly, which is a handheld ultrasound company. This is a Jonathan Rothberg company. He was famous for sequencing gene sequencing tech many years ago. Now he has an incubator with dozens of companies. Some of them went public via SPAC. In particular, the reason we're talking about the SPAC market is I think a lot of these companies went public at the wrong time. Butterfly went public at an okay time, November 2020. So it had some time. It peaked at $25, and then it went down to $1 or under. The reason I started looking at this space is I noticed a lot of these were starting to come off the bottom, and given the macro environment we talked about at the beginning, again, I think there could be. Look, it's like I'm reminded of Carvana, if anyone followed that, but Carvana was left for dead, and some of these companies get so dramatically low. Like Carvana was down at $4. I think it's up 250 now. So this is not retirement strategy. This is high risk companies, high risk situations. But the point is, some of these SPACs went to extreme highs, and because there was interesting tech there, good teams, that's why. But anyways, they're not at that level now. They're between $3 and $6, and so still quite a bit off the high. But the reason I like Butterfly is it does have interesting tech. The medical device simplification. So if you can plug it into an iPhone and use it anywhere as an ultrasound device, implications, for international markets to use these things that may not have access to the expensive machines. The core of the technology and the Rothberg technologies have always had strength at like the semiconductor level. So they build, with a lot of intellectual property and patents, at the genome sequencing level originally, and now, they have this sort of ultrasound on a chip is sort of the concept. But it's not a huge sales company, not a huge sales growth opportunity. But as long as they don't have to wait too much longer, if the world slows down and 2 years go by without much, economic activity opportunity like it was the last 2 years, as long as that doesn't happen, they won't have to dilute so much. Your biggest issue with all of these SPACs is dilution. If they don't have enough money, if they're not getting their sales up, they have to dilute, and that hurts you as a shareholder. But again, I'm looking at the technology. I think they have really neat technology. I think the price is low. Can
I ask you just talk to me about liquidity when it comes to these types of SPACs?
Yeah, I mean, these are best as retail assets. These are not. That's why I also like them, by the way. Talking from the top view, when you are indexed, and most of the world is indexed or indexed aligned in their philosophy, the S&P 500 kind of controls everything, controls flows. Not only are SPACs not in the S&P, most of them are not in any indexes. Most of them are not in the Russell, for various reasons. Actually, one of these got into the Russell recently, Aurora, which is the one I want to talk about next. I have a vision or a view generally that, like, if a company can be successful enough to make it into the indexes, it's not a unique view for me. A lot of people have done this, but if you can find a company that you think will eventually make it into the indexes, that's just an enormous amount of flow that go to those companies. So in order to be in the S&P, you have to have earnings, and you have to have certain size. You have to be, I don't know, 25 billion, 50 billion, and with positive earnings. And that's a real hurdle to get over for technology businesses, who most of them don't have earnings for quite a while. Yeah.
But when you try and take on a position, right? I mean, you've got to accumulate that, presumably, right? I mean, it's not going to be like that. I think of these almost like micro caps to some
They're
extent.
definitely micro caps. I mean, so all these companies are like a couple $100 million, up to Aurora is 10 billion, which is the next one that I want to talk about. So that's quite a bit more liquid. But yeah, many of these are single, are a couple $100 million market cap companies, which is as micro cap as you can get. But what I like about them, again, is I think that they're institutional, like kind of venture capital style assets. Like, they're not obscure. There are a lot of obscure micro cap companies, that come to market through obscure broker dealers. They need to raise some financing, and you're like, why does this company even need to be public? That's not really the case with these guys. A lot of the SPACs, they are exit liquidity for venture capital, but they've followed a normal path in that they had a vision, they raised capital, they found a market fit, they have real technology, and they're going through their next cycle, which is just growth. They need to grow. They're public. They need to act like public companies. They need to hit milestones and report on them. But yeah, in terms of your question about liquidity, it's not something that, like, look, big funds can't take positions really in a lot of these companies. Are too small. But I think that's an opportunity. I think it's an opportunity for smaller funds. And that's why I feel like it's an opportunity for, like, the small hedge fund that we run to take positions in companies like these, because we don't have liquidity issues.
Let's talk about some of the other SPACs you're paying attention to.
Yeah, so Aurora is a driverless truck company. It's like, Uber owns 20% of them, $10 billion market cap. Toyota owns 2.5%. Amazon owns 2%. These are like a really long duration play. They're pre-revenue. They have a long roadmap. It's going to take them till 2027 to really start unlocking it. They're playing the game very conservatively, but they're pretty much the leader in driverless trucks. They're running a route between Dallas and Houston. Also, I have to keep saying it in here, but it's not promotion. These are just views that I think are interesting for your audience. I think in analyzing individual companies is really an important exercise, even if you don't invest in individual companies.
It's also a rare art nowadays, right? It's like, because everyone's really talking more macro and broad based.
But that's why I'm doing it, because it's like, my whole career is people like, don't pick stocks and don't try to time markets. And I specifically have exercised my right to pick stocks and time markets now, and I've done well with it, and I really like it. Plus, I just don't like the complacency of buying an index or the market without looking at the underlying companies. And the underlying companies exist at all levels, from Amazon down to SPACs. It's just I feel like you can't make a real confident comment on the market or the direction of market if you don't know the details of the companies that are operating within them. So dilution is also an issue with Aurora. They also went public on November 2021, the worst time to go public on the SPAC market. That's when the crash started, November 2021. But that's driverless trucks, which is just like a very obvious huge market, ridiculously huge market. I don't know how many truck drivers are employed. It's in the millions. I don't think analyzing these companies in terms of market TAM is like a useful exercise in this case, because again, I think your biggest issue is execution on the price that you can get in. They can be really volatile. Prices can move 20%, 30%, few days. But again, if you're buying these, not in 2021 when everyone was extraordinarily excited about them, but now in 2024 when no one even wants to look at them or talk about them, again, I think you're getting like a venture capital like deal. But again, you have to do your own research and feel like what you're looking at and what you're buying. But again, dilution is your biggest issue by far. The other two, I'll just touch on them briefly. Helion is they kind of failed at their first SPAC, a vision, which was which was running a generator on a truck to power an electrical kind of drivetrain. They kind of gave up on that, and they acquired tech from GE Aerospace that allows them to run a 3D printed engine. Emphasis on the 3D printing, by the way. When they print this engine, it's got a really beautiful geometry that allows them to basically extract heat and distribute heat to operate the engine. That allows them to run it on 20 different fuel sources. They can run it on hydrogen, ammonia, diesel, gasoline, and they've demonstrated the ability to swap out the fuel live while the engine is running. So they've won some military contracts with that, which I think are interesting. They're kind of pre-revenue is also, but if you're going to look at any of these, I would look at the tech first, see if you understand and believe in it, and then make your decision from there. But they had a crazy run. They went public June of 2021 and at 10 and went up to $50, like an absurd run, and then went down to like 50 cents. But they're back off their bottoms, right? They're kind of in that $3 range. So that's what kind of caught my attention. I do think markets tell you something about the future. So the price running and the momentum running, tells me something. But there is a lot of work that a lot of these companies need to do. I happen to think that GE asset that they acquired is pretty neat. It would be interesting to see how they monetize it. It's run by a young CEO who's talented and happened to go to my high school. I didn't know him, but I saw that. I researched all the management teams extensively, because again, that tells you the origin of the company. It's not just management is just so important. So you have to know who's running these. I'll pause there before I do the last one.
Yeah, no, that's good. And I'm curious, how do you even come across some of these companies? They sound so almost like you have to accidentally stumble upon them.
Well, the screen again started with distressed SPACs, so
Yeah.
so I had to look. There wasn't really a filter on what I was using to find just SPACs. I'm sure someone can use a filter there, but it's like companies that IPO'd 3 years ago, 4 years ago, down between 40 and 70% from. I don't want to. I'm not ready to bottom fish. I'm not going to buy something for 50 cents or $1. I want to see some positive momentum. So again, another screen, it's like the stock price is under 10. You know, once you do this, you can sort of get to a list of about 100 or 150. And by the way, what I found was there was another one. I think CTV was a ticker. They just got acquired and had an 87% pop on the acquisition. So we saw this with software like 2-3 years ago, and probably still happening now. But companies that were so depressed after 2021 that were publicly traded software companies were getting taken public en masse by Thoma Bravo because they were doing their own underwriting, being like, look, this public price doesn't make sense. Let's just take them private. And look, they have the billions to do it. So they've done that. So I actually think that any of these SPACs that are too low, I don't know about the process of acquisition, but there are SPACs that have been taken private at premiums to what the price is now. Which again, I think gives you another opportunity. But yeah, you have to know what you're screening for. Like I picked these 4 because they had real technology and went through them one by one. Based on like kind of the carnage that was left over from the SPAC, cohort from 2021.
How do you think about how much risk you want to take with portfolio in these areas? Typically, I mean,
yeah. I mean, these are small positions. Like it's just like you would take if you're talking about your net worth, you have to look at like what would be your venture capital allocation, and then these would be a small portion of that, and then they would also be a small portion in terms of execution. So I'm a big believer in buying in thirds. First third for the research, and to see if you're getting the timing and the momentum correctly. Second third is to double down, and final third is to, not go all in, but just to like add to the position. So discipline and execution is really important. I would never buy any company and say like, okay, well, this is great. I'm just going to wait now a few years. I think it's nice. You always want to find the companies that are going to run for many, many, many years, like Fang has. Any of the companies I'm looking for 3 to 5 year holds as a goal, but they also may not pan out, and I may want to change my mind. Like I said, I may want to change my mind tomorrow. I might see something that I really, really don't like. Typically something related to the management or the way the management is running the business that just gives me cold feet. Because if you think about it, you want like 10 different measures, and all 10 boxes have to be checked. And the second one of those unchecks, you don't have to be involved with any of the companies. You can wait till your next shot. I think it's really important to have extremely high expectations for execution. The second the management team lets you down, you should vote with your feet. So the last one I'll just add before we run out of time is Planet Labs, which is 10% owned by Google. They're a satellite constellation company. And my kind of thought on the tech there is you can't really just strap a camera to all the SpaceX satellites and expect to get all the imaging of the Earth that you want. Planet Labs is really focused on, highly technical imaging satellites that are full spectrum that can read the Earth in many different ways. You can say there's an ESG element in that they're monitoring for leaks, but there's also a safety element to that too. You don't want pipelines leaking methane gas or however you want to, whatever you're looking for. But actually on Planet Labs, just shout out to a hedge fund I shared an idea with, who got this idea from for Planet Labs was Adapter Capital, Mark over there. I just want to give him a shout out. They had done work on this, and that did help influence a little bit my interest in looking in distressed SPACs, because again, this was a SPAC that went public at the worst time, again, November 2021, right before the bust. at $10. I think they got to $11.50. They fell to a low of $1.70 or something like that. But they're about $1 billion valuation. Look, very technical CEO. I think you would look at any of the people running these companies, and they're so unbelievably successful. Generally speaking, these managers and their capabilities. They're not business people that just found a business plan and spun this up. They have extremely technical backgrounds. So that's part of my interest there. But yeah, so their imaging system for the satellites for Planet Labs go down to 50 centimeters, 20-inch pixel dilation. So to the extent that that's useful for people, again, kind of pre-revenue. But again, it's tech. This is venture capital. It's up to them to find their market and capitalize on it. And you're not buying at $11.50 where it was in November at the SPAC mania. You're buying at kind of like $3-4.
Max, for those who want to track more of your thoughts, more of your work, and maybe choose you as their financial advisor, where would you point them to?
Yeah, so osboncapital.com is the website. I write a weekly article that attempts to kind of put all this stuff together, although this is a unique one where I've gone into individual companies. You can't really do that with compliance. So that's why I keep saying, do your own research, and that might change my mind tomorrow. But we do run a small hedge fund. We run SMAs. We manage retirement capital. I think all of those are linked together. I think being a good risk manager on the risk assets makes you a better risk manager on the less risky assets. And we're an independent investment, boutique firm. So we can and do implement all kinds of strategies.
Everybody, make sure you check out Max Osbon, his firm. I appreciate those who watch this live. Again, this will be an edited podcast under Lead Lag Live, and I will see you all on the next episode as I get ready to go to another event tonight. Thank you, Max. Appreciate it.
Thank you, Michael.
Cheers, everybody.